Welcome back to Golden Rule Radio. We have a lot of questions from listeners and clients about what's going on in the gold market, so we're going to address that today on the show. I think we have 4 different points we're going to cover. I'll start with one of the points that's not on your list there of the 4, so I'll add a 5th. The gold price came down below 1,200 and ran into a line that was a 1-4 Elliott wave line. Miles will draw it on the charts here so you guys can see. I drew this line back on the chart back in probably like February, March, when we came down and had a wave 4 bottom. And so we just came into that 1-4 line right at 1170 and haven't broken below it, except for just intraday.
Sure, and that intraday move right at that 1-4 line was also right at the 786 fib that we've been emphasizing for a couple weeks.
Which is one of the 5.
Hang on.
Okay, so 4.5.
The technical support levels are one of the encouraging points to bring up this week, right? That those levels are holding. That to me is very encouraging, especially when, again, going back to February or March, we talked about the 1185, 1170, 1175 support levels as being ultimate bottoms for any potential downturn, and that's what we're seeing.
Sure, and generally trend changes are pretty aggressive, and you see how aggressively we came down, popped right back up intraday, and have moved up since then. Definitely lends some credence to the idea that could have been a bottom, or certainly we may be seeing a bottom get put in as the price action presents itself over the next week or two. Maybe a double bottom, maybe some RSI divergence. But I think here in the mid 1100s to high 1100s, we're seeing what I was hoping we'd see at 1212. But I'll take one more correction back down below that.
I agree. Just a better opportunity to step back in. Now, we also been talking a lot about seasonal trends, and let's kind of put some numbers behind what we've been talking about. Miles, you've done a lot of exhaustive work here in the last few weeks on sort of putting some objective measurable numbers to what we've been trying to say from a seasonal trend standpoint.
All right, guys, tell me if you hear a pattern here. So last year, July 17, 2017 is when we hit bottom seasonally, 12.6% rise. Previous year, May 30th, 14.5% rise. Back to 2015, mid-July, 11% rise following. 2014, June 3rd, 8.5% rise. 2013, June, 21.5% rise. 2012, May, 17% rise. You guys starting to hear a pattern here? May, June, July?
Right, and those dates, you're talking about that's the bottom?
That's the seasonal bottom, or when we've seen the turn take place and then following back up. So, and you can keep taking this back all the way to 2002, May, June, July, over and over and over again. Now, so there's one exception to this, and that was 2007, where we didn't put a bottom in until August 15th. Now, what happened following that bottom in August 15th?
I have my hand up. I think I know. I think gold went up about 150% from there, right?
Yeah, in fact, it was up 30% just by November, 31%. It was up 61% by the following March. And then obviously we saw it march on up to over 1,900 at that point. So the only time since 2001 that we put a later bottom in than June or July, we followed with the largest gold price increase since the early 80s.
I'm actually completely encouraged by that. I'm also encouraged by the fact that you've mentioned 17 or 16 out of the last 17 years that seasonal trend has held up. That to me is amazing. Now, point number 3, okay, we've done technical, we've done the seasonal. Let's talk about what's going on right now in the futures market. Okay, it explains a lot as to why the gold price is suppressed. We have a record number of short positions in the futures market right now in terms of gold, right? Now, the biggest position actually was taken earlier in the summer. We have another internal analyst who's done a lot of work talking about what has happened following that 2 to 3 month period of time where such huge record short positions were taken in gold, okay? Back in 2006, within 6 months, you saw a 3% gain. Back in 2007, a 37% gain. Back in December of 2013, a 10% gain. Back in 2015, a 3% gain. Back in 2015, a 26% gain. Here are the key numbers. I know we're throwing a lot at you. That averages a 15.9% gain 6 months after those record short positions are taken because they have to go cover the shorts. David and Kevin do an amazing job of talking about this last week and this week on the weekly commentary. The other thing that you see is within 12 months, you're averaging over an 18% increase in the gold price, that it's that healthy for that long.
And what you're referring to there, Tori, is the commitment of traders report, showing how many traders are short, how many are long.
Exactly. So go do your own research, check our math, and do your own due diligence on the commitment of traders report.
I think something else to bring up on the COT report too is what we're looking at. When you look at that weekly report come out, you can look at the commitments of traders, but you can also look at the commitment of the industries that actually use precious metals. A lot of times these industries, because they own precious metals, because they own mines, that actually counts as a quote unquote long position, because they own a position while they're holding it or waiting to sell it or coming out of the ground. That can be considered a gaining asset as the price of gold or copper or whatever's going up. So in order to offset those positions that they own physically, just like we do as a company with our own inventory.
Hedging.
So if we as a company or a company that does mining owns a large position in gold, they'll go and they'll buy short contracts on the other side just to hedge the price moves up and down. So while we're seeing trader positions increase on the short side, as the price goes down, we're actually seeing a diminishing position of the industrial side, because as that price goes down, they don't have to hedge their bets as aggressively.
So that's 3 of the 4. Moving on to the 4th, it would be premiums in the physical market. That's the reason that I wasn't here last week. Miles did the show solo because people were buying. And so we're going to talk a little bit about what we've been seeing from our desks here at the office, talking to clients. People are moving money.
You know, it reminds me a lot. We did the 10-year retrospective 2 weeks ago, okay? It reminds me a lot. We mentioned Silver Eagles going up as high as 40%. I'm sitting with a client the other day. All of a sudden, I'm realizing a Silver Eagle is around 20% over spot, to the client in the retail market. That's a huge premium for a bullion coin. It's also up about 5%, and that happened in a very short period of time, a matter of 10 days. So yes, Robert, we're seeing premiums, and we're not just talking about the semi-numismatic or the rare coin market. We're talking about bullion.
Yeah, Tori, as the price is coming down, we're definitely see the buyback price come down alongside it. But what is fascinating is how the wholesale market will not lower the ask prices alongside the decreasing spot price, because so they're softening that spread between buy price and sell price coming out of the wholesalers or coming out of the mint, because they don't believe it's going to stay there long. And they're more than happy to just sit on product or keep a higher price to where they're not losing any profit they may already have built into the coin. So we're seeing the softening or the spread out of the buy price versus sell price industry-wide right now.
Yeah.
And we saw that during the big drop around tax time a couple years ago when the gold price came down like $150 right around April 15th.
People kept buying.
And that's what we were talking about when those Silver Eagle prices went up to 40% above spot.
Mm-hmm. And what happens, to your point on the premium and the spread, 2 key terms. The premium in percentage terms is the amount you're going to pay for a product over the spot price. The spread is the difference between what you can buy it for and sell it for in the open market. Okay, so the premium's up 5%, but guess what? That's all indicative of a widening of the spread, which has also increased 5%. So all of that gain is in the wholesale spread. That being said, we're also seeing premiums change in the double eagles market. So early in the summer, we were talking about the value in semi-numismatics or that rare coin market and why you should look at it as an investment grade coin, as a premium play, and guess what's going on?
And that's a really good point, because when we see these declining price markets, those spreads tend to expand on bullion product because the mints don't have to sell. They don't need to. They don't need the income. Wholesalers can sit on their positions. They're not willing to get rid of their inventory at substantially lower prices, so they're happy to just sit on it for 6 months and make sure the market turns around. Now contrast that with a rising market environment where the premium on bullion tends to shrink, but then the premium on rare coin tends to expand.
So to wrap this up, those 4 points are giving you good reason for stepping into the gold market right now. And we've had some savvy buyers, people who've been doing this for a while, stepping in because they recognize value. They recognize this is not going to stay this way. They recognize a number of the things that we may or may not have pointed out here. But these 4 things we think are key in that we're probably turning the market right now. It really depends a lot on the dollar. We didn't talk a lot about the dollar at all today, but these indicators in the gold market tell us something.
They tell us something and they're speaking it loudly.
They are. If this show has created even a mild interest, then just pick up the phone. Talk to us. We'll give you specific recommendations. Call us at 800-525-9556. You can follow us on Twitter at ICA Gold. You can like us on Facebook. You can go to our website at McAlvany.com. Thanks for listening. Have a great week.